Coming to you live on Thursday, last Thursday of October. Hard to believe. Means Thanksgiving's right around the corner and the wonderful holiday of Halloween. In my family, we've been doing it for a very long time. It's a fun holiday. I'm sure my wife can't wait for the scary decorations to go down so that we can have just the beautiful fall decorations for the season of Thanksgiving, which is right around the corner. So happy Thursday to everybody. Glad you could join me. And without further ado, let's get right into this. This is another housing debrief, and we're sponsored by Mac Financial Services. So let's see, there we go. I'm going to invite everybody to go to reportsonhousing.com. If you're watching on Facebook, navigate over to reportsonhousing.com. The reason for that, not reports on housing, excuse me, YouTube. Go to YouTube and we're hashtag report, not hashtag. Boy, my brain's not working. I guess the ghouls have already taken over me. But anyways, go to YouTube and we're Reports on Housing. And so youtube.com/reportsonhousing, go there, like, subscribe to our channel. I guess I got to go back over there to see where it is. My brain is a bit foggy. Anyhow, go to YouTube and smash that like button and subscribe to our channel. It'll help with the YouTube algorithm and just get the good information out to the masses. That's what it's all about. So it's cutting through all of that all of those narratives that are out there. Everybody has an opinion when it comes to real estate. So we've got a creepy housing update for you. But first, I want to go back to the Fed-inflated housing bubble. I kind of did a little bit of a disservice and called it a bubble, and it is a bubble that the Fed has inflated. However, our forecasts and predictions based upon everything that we're seeing as far as how incredibly strong the housing stock is across the United States. There's a bit of stickiness to pricing, but prices are definitely falling. They know that they have quite a bit of equity so that they can come down in prices. And so we're getting this slow deflation of this bubble that the Fed has inflated. We would not be talking bubbles or anything like that had it not been for interest rates going from 3.25% to 7%. And nobody knew that this is where it was going to go. Not even the Fed did back in December. And then when they spoke again in March, their tune totally changed as the year progressed. So they've inflated this bubble, but it's only slowly going out, because what happens with the bubble, if it were to burst, and it was really a bubble, because we anticipate down the road that we can get some easing in interest rates. If we don't, we can definitely continue to see this go down until we get into a recession. There's a high likelihood of a recession coming forward, and once we get that, typically we get a bit of relief in interest rates, which would stop how quickly prices are falling right now for housing. But prices, we don't anticipate them falling 35%. That is what constitutes a bubble, when prices go down by an alarming number. And so that's not what we're really calling for, is not a bubble in prices that come down, but we are calling for a correction. It's exactly what the Fed has ordered. They talked about it in their when they were explaining what they meant by a housing reset in June. They explained it in a Q&A in September, that what they meant by a housing correction for a reset in housing is it's going to be a correction. He said correction a few different times in his answer on what he meant by housing reset. And a correction is anywhere from 10 to 20%. So, and right now where we are, our prognostication, our forecast for where value is going to go next year is actually down 10 to 12% for Southern California. And I can definitely see it happening based upon the trends and everything that we're seeing. So it's going to be right in line with the correction that the Fed wants to see in order for them to back off of everything that they are doing. So anyways, let's get back into the creepy housing update. And yes, it's that time of year where you put out your best pumpkin. There are quite a few pumpkins here. Sure. Can you imagine if that was your neighbor? I don't know who carves it. The whole entire neighborhood, the city. I don't know, but that's a lot of pumpkins. And I thought this was great. Had to share it because I'm a housing analyst, and my wife turned me upon this. I thought this was great. this is a great way of decorating your house. If you have a house like this, please do something like this or something like this. I think that's pretty fun. We don't quite have the porch for this, but man, it would be fun to decorate your whole house like that. The interest rates are where we've seen the creepy rise. This rise that we're experiencing is an unprecedented rise from the very beginning of the year to where we are today. This is actually the Freddie Mac mortgage market survey. Now, I've been doing the daily, but finally the Freddie Mac mortgage market survey has caught up to the daily what the daily mortgage rates are. And I wanted to bring you this because this is Len Kiefer over at Freddie Mac, and he makes the best charts. He's doing this on behalf of Halloween, and it's just a fun chart to take a look at. But you can see how much interest rates have come up. And a matter of fact, when you draw a line across from 7.08, the last time we were here was April of 2002. So if we were to get a CPI reading or something else that is extremely hot and it's too high, or we're showing that the economy is too hot, you're going to start to see that rates could even move higher into the sevens. And if that happens, like earlier this week, we were at levels that we had we had last seen in 2000. And that's just, if you get to like 7.3%, the last time we were here was 2000. So you can see that we're at these unprecedented levels of rates. We've been here before. People go, yeah, we've been here before. I had my first interest rate was like 8%. But the problem is these interest rates are so high when you plug in where values are today, and then where incomes are today, it just comes out not looking good for as far as home affordability is concerned. And that's why we're getting such a seizing of demand. And if you go back in time with interest rates, this is also from Len Kiefer, and you can't really see it, but what I'm showing you, you can't see the red box in the lower right-hand corner. And the last time we were here was, you could see there's a red box, the second row up from the top, and that's 7.18%. There was only 7 weeks that year that had interest rates above 7%. And right now, we've only had one for the Freddie Mac mortgage market survey for this year. This year, we've actually had 10 weeks with interest rates in the threes, 5 weeks with interest rates in the fours, 21 weeks with interest rates in the fives, and 6 weeks with the interest rates in the sixes. Only 1 week where interest rates have been in the sevens for a week average. And this is brought to you by calculatedriskblog.com. Pretty cool. So what he's showing you is the difference in payment from year over year difference in payment. And you could see this goes all the way back to like 1977, January of 77. And this is the biggest payment differential annually. So that is also unprecedented. People like to compare it to 1981, but the difference in payment wise is so much different from one year to the next. And that is why we're getting such a slowdown on the demand side of things. This is where we are right now. And I like pointing this out. This is also from Len Kiefer. He's a chart wizard. You can go to Twitter and look up Len Kiefer, and he's got all these. This is every year for Freddie Mac mortgage market survey. I've showed you this before, but I just wanted to point out one of the lines that I didn't point out before. And this is every year the change in interest rate from the very beginning of the year. It's at 0. And you can see how interest rates change over time. Well, this is where we are right now. We've had the biggest change in interest rates since this started 51 years ago, from the beginning of the year to where we are now. We exceeded 1981. This will be the biggest change in Freddie Mac history. And it compares it to the 1981 that I was talking about. In 1982, it went into a recession, and you can see what happened, that actually interest rates fell. And it's kind of one of the typically we get rates that fall, and this shows what happened in 1982 where rates did fall. So I wouldn't expect rates to go down 4%, but you have to understand that as far as there would be a bit of relief, could be a bit of relief if and when we actually start a recession. We're thinking that the recession most likely is going to show up in the second quarter of 2023. So we're going to be stuck at these higher rates until we get into the recession. So we might not even see rates come down until we get later on in the second half of 2023. And We're going to talk about this throughout our presentation here. And what I want to talk about is the pain that the Federal Reserve said that they're going to talk about since they all started talking about pain for pain for the consumer, pain for companies. And that pain started, according to them, in August, the fourth week in August. This is when they came out and spoke after meeting at Jackson Hole, Wyoming, for the economic symposium. They came out swinging. And then again in September, they came out swinging. So they really are trying to slow down the economy. They didn't like what they saw in August. So demand, where is demand right now? Well, of course, demand is really low. We've only been a little lower a couple different times. One of them is the very at the start of the pandemic. That is right there in the middle. That's that little trough that you see. That trough that you see is actually when we had the lockdowns. That's the V. It went down and then right up. The other time that it went below where we are actually at today is the very end of 2018 when we had interest rates that approached all the way up to 5%. Can you imagine 5%? We'd take 5% interest rates right now, but back then it was enough where we went from 4% to 5% in 2018. And it was enough to really slow down the overall housing market. And that's because a lot of homes came on the market, lingered, and we had a big inventory. We had a much higher inventory than where we have right now today. So demand, this is a snapshot of the last 30 days worth of escrow activity. So I'm looking at the same thing over time. Today we're at 9,383 for Southern California. It's down 7%, or down 742 pending sales from 2 weeks ago. And you can draw a line across. You can see in the middle there, that green, that was COVID. So there's only 2 times where we got lower. And you can see the other one is the purple line on the very left hand side. It was the very beginning of 2019. So we had a very, very low demand reading at the beginning, but then interest rates really started to drop, and we got demand definitely recovered in 2019. It was lagging what other years had done, though. But so there's only 2 times, like I said. And last year at this time, we were at 17,556, which is 87% higher. So it's almost making its way up towards double where we are today. So we have almost 2 times the number of, and I'm going to get there by the end of the year because we're already October. Sometime in November, I think it's going to be double the number of escrows from where we were just 1 year ago. But you have to understand, we're comparing it to a year where that's a unicorn year. We did a lot of transactions in 2021, and everything that came on the market sold, regardless of what it looked like, where it was located, what kind of deferred maintenance it had. Everything seemed to sell almost instantaneously. So, and it was the highest number of closed sales since 2005. So it's not really a fair comparison. I like to compare it to the 3-year average prior to COVID, 2017, 18, and 19. And that's still 53% higher than where we are today. We're 14,000 versus 9383. So yeah, that's a lot more pending sales. Now, this is where the Fed came out and talked about pain. Right there, you could see actually in August, the demand started to improve because we had interest rates that went down to 5%. So improved slightly. We're way off compared to other years, but we did get an increased boost in demand until Jackson Hole, Wyoming, and the pain speech. And September 1st, it was at 12,498. It has gone down. Demand has gone down 25% since they came out talking about pain. And that normally during that time period, we actually slightly go down in the autumn market. So does inventory slightly go down. It actually it's supposed to go down about 9%, instead went down 25% in that period of time. So you can see that that has everything to do with interest rates have been rising since September 1st, where they were in August, they were all the way down in the 5s, and they've made their way all the way up to 7%. That is a big change in just a short period of time. And like I said, lowest demand reading since April of 2020. So our sponsor, Alan Mack, he's back. Mack is back. I love that. Alan Mack is back. Mack Financial Services. And he has what he does is the $1 million plus. That's what he does. He's superior luxury residential financing. That is what he focuses on. And he has non-conforming loans above anything above 647,200 is actually considered jumbo, and he has excellent jumbo products for that. He shops the lowest rate. He gets the best rate in town. And that's because he's leveraging this network of private and regional banks that he works with. He knows the best of the best because he's been doing this for so long. He knows the best of the best in each of these banks. And he has high net worth clients as well that he works with. Besides the non-conforming loans above 647, he does a cash flow analysis, asset depletion. He can get them loans based upon that. So it's not the traditional way of doing things, but the high net worth clients, they can do some things that are different as well. He has a special 3-2-1 buy down where the first year starts off in the 3s, then it goes to the 4s, then it goes to the 5s. So, and he's got a load of experience. He's been around for a long time. When you talk to him, he knows lending inside and out. He's been doing this since 1988. He has over 100 5-star reviews and has unparalleled knowledge. So you too can give Alan Mack a call at Mack Financial Services. Contact Alan Mack and let him get you the lowest rate at 949-929-1091. That's 949-929-1091. And let's see. So now let's talk about inventory. Thank you so much, Alan, for your continued sponsorship. Let's talk about inventory. And where is inventory right now? Well, the Southern California inventory has improved quite a bit, but when you draw a line across, you can see we've been a lot higher. Those are the averages in time. As a matter of fact, where we are, it's still where we often are at the beginning of many, many years. So this is the Southern California active listing, the number of available homes. Today, it's at 30,974. It went up 1% or up 362 homes. This is not typical for this time of the year. Normally, it is going down at this time. And last year, we were at 18,439. That was an all-time low that I had never seen before for all of Southern California. It's 40% fewer than where we are today. The 3-year average is at 40,036. We're at 30,000, almost 31,000. We should be at 40,000. And that's 29% more than where we are today. This is where the Fed talked about pain. Once again, I'm pointing this out because since then, we were at 30,148 on September 1st. It's actually gone up 3%. So it's kind of like flatlined and it's actually risen. Normally, it goes down 2% prior to COVID. That's the average. So normally that's what it does. It goes down 2%. So you could see that because of what's happened with pain, that this has that this isn't going down like it normally does during this time of the year. It would have even increased more. This line would have increased even more had it not been for people that are staying in their homes, and there are fewer people coming on the market right now. And what we have is, you could see, this is where we are for Southern California, the number of properties that came on the market, a little over 15,000 for the month of September. And you could see where normally we are for the month of September. So it's this trend looked like the new trends that we had when we first had COVID lockdowns, because people couldn't sell their homes, fewer people came on the market. Now we have this new trend that's developed, and it's just people that are hunkering down. As a matter of fact, you can see right here, I'm pointing to that 0% line is the average, 3-year average from 2017 to 2019. You can see how far below we are, where we are nearly 23% less than where we were than what normally comes on the market just for the month of September. And so people are hunkering down. This is what I'm talking about. And in California, now I'm taking this from a mortgage data bank for the entire country, and they do this on a monthly basis, and they tell you how many people have certain interest rates. Well, the number of people that have an interest rate of 5% or lower, it's actually 89% of everybody in California. Now, they do the United States. Now, California has even stronger numbers that argue hunkering down even more than the rest of the country. 89% have an interest rate of 5% or lower, and 71% have an interest rate at 4% or lower. 29% have an interest rate at 3% or lower. So let's get into, that's why people are hunkering down. They're staying because they just don't want to move because they have such a good rate compared to where rates are today. It's the highest differential from where they were before to where we are today that we've seen in decades. So that's keeping people in their houses when you have such a quick shift in rates. So the expected market time, this is you place your home on the market when are you opening up escrow. The longer it takes, the slower the market, the more it favors buyers. The faster the market, the more negotiations favor sellers. Well, this is where we are right now, and you can see that spike. That is very, very interesting. So you could see that we're right now, we're approaching 100 days. You could see we're at about 100 days, and we have been higher than this at various times. Most recently, we were here when we first went into COVID. It was actually slower than where we are today when we first went into COVID. And also, like I said, when we had interest rates at the end of 2018 and at the start of 2019, you could see that the expected market time was really high, that it really slowed down. And we just had interest rates at 5%. So that was that change from 4% to 5% that caused that. And that's because we had a lot of homes on the market, a normal number of homes that came on the market and languished on the market, which is what normally happens. But we have interest rates that are so high that people just are not placing their homes on the market this time around. So the expected market time year over year for SoCal today is at 99 days. It went up 8 days in the last 2 weeks. So we were at 91 days 2 weeks ago. Now it's at 99 days. So you can see this is actually growing longer as the year progresses. And that's not normal for this time of the year. Typically, you have demand and inventories falling at the same rate, and it kind of flatlines. You can see that in the purple line, the green line, and the red line. The purple line was actually 2019, red was last year, and green was 2020. So it's pretty much what you see is what you get for the remainder of the year. That's not what's happening this year. Instead, it's right now we've slowed to the point where it's the slowest since April of 2020. There are not that many points. January of 2019, we were right around this level as well. But there are not that many points since 2012 where it was slower than where we are right now, other than, like I said, the 2018-2019 period and when we went into the COVID lockdowns. The 3-year average is 85 days for this time of the year. This is that time where, of course, the Fed came out and talked about pain because they didn't even like the direction that real estate was going. They didn't like where stock markets were going. They didn't like how interest rates had come down. There were so many things that they didn't like that they came out swinging at the end of August, coming out of Jacksonville, Wyoming. And since they said that, we had that big drop in demand and we had inventory go flat. So as a result, on September 1st, we were at a 72-day expected market time versus where we are today at 99 days. So big difference. And as a matter of fact, as far as LA is concerned, back on September 1st, we were at 74 days, and now it's at 99 days. Orange County went from 61 to 87 days. Riverside County from 78 to 112 days today. San Bernardino, 87 in September to 113 days today. San Diego from 60 to 82 days today. And Ventura from 53 to 75 days. So you get the point. Across the board, everything was in a much better spot back in at September 1st to where we are today when it should have been flatline. And if I compare these to March is where everything was absolutely insane. And we had most markets in either the teens or the 20s, or LA County was one of the highest at 30-day expected market time. But going from 30 to 99, what a big change so far this year. And right now, the metrics kind of show a balanced market. Between 90 and 120 is what typically shows a a balanced market. It's above 120 that's buyers. It's above 150 where it's a deep buyer's market. But really, the market is behaving like a buyer's market right now, a slight buyer's market, not one that is dropping like a rock because you have people that are freaking out and can't afford their monthly payments. That's not what's happening. That was the Great Recession. This is a totally different ball game this time around. But what we're looking at is the model that everybody uses for supply and demand is actually broken. And the reason it's broken is because of unaffordability. So things are so unaffordable that it's putting pressure on prices because there's so few number of buyers that are out there. So the buyer pool has shrunk. And you could see this. This is actually May, June, June, July, and August. On the right side is a triangle. And let me point this out really quick. So the way that this works, this is calculated risk blog. At the very top, that's 0 month inventory. Then you can see that next it's at 2 month inventory. Then you can see further down it's a 4 month inventory. Then it's a 6 month inventory. So when you have less than a 6 month inventory, and on the right, this is where its values haven't changed, right there in the middle, that black solid line. To the right of that is where values are rising. And the lower the inventory, the more that it typically you see home prices rise. On the right side, you can see it went 2% up in a month. And you could see that this was when we had inventories of right around 2 months or less. Inventories are still below 6 months. Typically what happens is when you're above 6 months, on the left-hand side down is all markets above 6 months. Typically you see values actually dropping. There's sometimes when you have above 6 months and values are not dropping, but typically that's where you see values dropping. But you can see here, once we got to July and August, and I'm sure September and October, you're going to see that even though we have a limited supply, this is something different happening, really following the model, these outliers. And you can explain the outliers. It has with higher mortgage rates. You should not have a inventory, the months of inventory be below 4 months, and yet we still have values coming down. That's the whole point in showing you this. You can see how economic models are a bit broken. But by the remaining buyer pool, because it's so small, it is definitely cautious. It is definitely cautious. So, you know what? Buyers are doing their homework and they're being very, very careful. There's not a lot of people that are purchasing things instantaneously. This is from Altos Research. It's only 16% of all homes, and it's dropping, sold their home instantaneously. These are detached homes across the United States. So, and it was at a high of like 35% earlier this year, and it's down to 16% sell within that first week. So fewer and fewer people are selling instantaneously. Case-Shiller came out a couple days ago. I love this index because it's like for like properties, and it really does show you where values are going. But it also it's also dated. The most recent one that came out is for the month of August, and it includes June, July, August. It's a 3-month window that keeps on changing. So because it's June, it still has stuff that went into escrow in April and May, but by April, you know what, it still was a bit frothy. So this is going to continue to go down. But so far, what you're seeing in the Case-Shiller is values are coming down. Now, it was at 20%, over 20% earlier in this year, and now it's at 13%, up 13% year over year. But if you take into consideration for a couple of the different markets, that LA is down 4% in that period of time, and San Diego is down by 5.9%. Pretty much most markets by the time it gets to the end of the year are going to be pretty close to 0% year over year, which means we'll be giving away everything that we did at the very, very beginning when everything was too frothy. And buyers don't like frothy comps. It's coming back down to where we were, like as if 2022's increase never even existed. So if you want a copy of this, you have to be a subscriber. Go to reportsonhousing.com and subscribe. It's really simple. Just go there, click on subscribe, and we have reports that all over Southern California, LA, Orange County, San Diego will get a new one this coming up Monday. Riverside and San Bernardino got theirs this last Monday, and we're still working on the Bay Area. If I catch a breath, we'll finish it. $15 per month or $150 per year to subscribe. You get a month free, and you'll get the most recent one called Pricing is Crucial. That's the most recent one. Then, like I said, Orange County, LA, San Diego gets a new one on Monday. But Pricing is Crucial is the most recent one. Utilize the coupon code Halloween to get that free month. And go to reportsonhousing.com to subscribe. That's all I have for you today. I appreciate you, staying tuned, being with us today. And any comments or questions or anything that you have, put them in the comment box. We'll be more than happy to answer them afterwards. So I appreciate it. I hope everybody has a great finish your week. I do have a special guest, a friend. Who's this?
Athena.
Athena.
I'm back.
She's back.
Don't think I went somewhere else. I'm here. I'm not turning into any teenager.
Sure, she's not.
I'm sure, Daddy.
She's sure. But anyways, well, thank you. What are you gonna dress up for Halloween?
Nacho Libre.
Nacho Libre. That's too much. That's gonna be pretty fun.
Or Cookie Monster.
You haven't even decided yet.
Yeah.
This is gonna be a last minute decision.
No, Mommy's not going to.
Yeah, we have boxes and boxes of Halloween costume. Boxes and boxes. They've been dressing up in them for about a few weeks now. I can't wait for that to happen.
Nacho Libre.
Boom.
You didn't blow it up. Hey, I'm a turkey.
All right.
That's all, folks.
Everybody have a good one. We appreciate you. See you on the other side. Have a good finish.